Look, I need to be straight with you about something that's been bothering me for weeks now. There's a narrative being pushed right now about precious metals that's not just misleading, it's dangerous for anyone who's actually holding physical gold and silver. And if you're a retiree sitting on bullion, what I'm about to share could be the difference between capitalizing on the opportunity of a lifetime and watching it slip through your fingers. Let me start with what they're telling you. Turn on any financial news channel right now and you'll hear the same tired story. Gold's at all-time highs, silver's volatile, and the smart money is supposedly rotating into stocks because the economy is strong. They'll show you charts, bring on analysts in expensive suits, and make it sound like holding precious metals right now is some kind of outdated strategy from your grandfather's era. Here's what they're not telling you. And I mean, they're actively avoiding this conversation because it completely destroys their narrative. Right now, as I'm recording this, we're witnessing the largest divergence between paper gold prices and physical gold availability in modern history. Let me explain what that means in plain English. When you see the gold price on your screen, that's primarily the paper gold market. Futures contracts, ETFs, derivatives. It's essentially promises of gold, not actual metal. But here's where it gets interesting. The physical market, the actual bars and coins that you can hold in your hand, that market is showing signs of stress that I haven't seen since 2008. And back then, we all know what happened next. I was talking to a dealer in Switzerland last week, someone I've known for 15 years. This guy moves serious volume. We're talking institutional level transactions. He told me something that made my jaw drop. He said for the first time in his career, he's seeing buyers willing to pay premiums of 8 to 12% over spot just to secure physical delivery within 30 days. Think about that. These aren't retail investors panicking. These are family offices, wealth managers, people who manage hundreds of millions of dollars, and they're paying massive premiums just to get their hands on actual metal. Why would they do that? Because they know something that the mainstream narrative is deliberately ignoring. Let's talk about what's really happening in the central bank world right now. In 2023, central banks bought over 1,000 tons of gold. That's the highest level of purchases in over 50 years. But here's the kicker. In the first half of 2024, they accelerated. We're on pace for potentially 1,200 tons or more. And it's not just the usual suspects. Poland just announced they're increasing their gold reserves by 100 tons. Singapore's been quietly accumulating. Even countries you wouldn't expect are loading up. Now, central banks don't do anything quickly. These are institutions that plan in decades, not quarters. When you see this kind of coordinated accumulation, it's not a coincidence. It's a signal. They're preparing for something. And the fact that they're doing it while simultaneously telling their citizens that gold is a barbarous relic, that should tell you everything you need to know about the game being played. But let's dig deeper into what's actually driving this because the mechanics are fascinating and they reveal why your moment is right now. The COMEX, that's the major exchange where gold futures trade in the United States, has been showing some really peculiar behavior lately. The ratio of paper claims to physical gold in their vaults has been climbing steadily. We're now at levels where there are roughly 100 paper claims for every ounce of physical gold actually sitting in the warehouse. Now, under normal circumstances, that's fine. Most of those contracts get rolled over or cash settled. People aren't actually demanding delivery. But what happens when they do? We got a preview of this in March of 2020. Remember the chaos in the gold market during the COVID panic? Futures prices and physical prices diverged by over $100 an ounce at one point. The market literally broke. They had to fly physical gold across the Atlantic on chartered planes just to keep the COMEX from imploding. And that was with maybe 5% of contract holders demanding delivery. What do you think happens if 10% demand delivery? 20%? The system isn't built for that. It's built on the assumption that most people will accept paper promises instead of actual metal. And right now, that assumption is being tested in ways that should terrify anyone who understands how this market actually works. Here's where it connects to you, especially if you're in retirement or approaching it. You made a smart decision at some point. You bought physical gold, physical silver. You didn't trust the paper promises. You wanted the real thing. And right now, You're sitting on an asset that's about to become exponentially more valuable, not just because the price is going up, but because of what's about to happen to availability. Let me paint you a picture of what I think is coming, and I want you to tell me if this sounds crazy or if it actually makes perfect sense given everything we're seeing. Scenario 1. The dollar continues to lose purchasing power, not collapse. I'm not talking about some apocalyptic scenario, just the steady erosion we've been seeing. 3% official inflation, but your grocery bill says it's more like 8 or 10%. Your insurance premiums are up 20%. Your property taxes are climbing. All the things that actually matter to retirees are getting more expensive faster than the official numbers suggest. In that environment, what happens to demand for hard assets? It goes up. But here's the thing. There's only so much physical gold and silver available for purchase at any given time. The mining industry produces about 3,000 tons of gold per year globally. Sounds like a lot until you realize that's only about $100 billion worth at current prices. Apple's market cap is $3 trillion. The amount of money that could theoretically flow into physical precious metals is orders of magnitude larger than the available supply. Scenario 2, and this is the one that keeps me up at night. Geopolitical tensions continue to escalate. We're already seeing the BRICS nations working on alternative payment systems. China and Russia are settling trade in their own currencies. Saudi Arabia is accepting yuan for oil. These aren't just headlines. These are fundamental shifts in how global commerce works. And every single one of these shifts reduces demand for dollars and increases demand for neutral reserve assets, like gold. Now, the mainstream will tell you this is a slow process. It'll take decades. Maybe they're right. But what if they're not? What if we're in the early stages of a rapid transition? Because here's what history tells us. These transitions don't happen gradually. They happen in fits and starts, long periods of stability, then sudden lurches. And we're seeing the lurches get more frequent. Quick aside here, and this is important if you're sitting on significant retirement savings. If you've got $100,000 or more in traditional retirement accounts, IRAs, 401ks, there's a strategy that a lot of people don't know about. You can actually move a portion of those funds into physical gold without triggering taxes or penalties. It's called a gold IRA, and I put together a free guide that explains exactly how it works. It's in the description below. Covers the rules, the process, what to watch out for. Worth checking out if you're thinking about protecting more of your retirement savings with physical metals. No pressure. Just want to make sure you know that option exists. Anyway, back to why your moment is now. Let's talk about the supply side, because this is where things get really interesting. Gold mining is not like other industries. You can't just decide to produce more gold because the price went up. It takes 7 to 10 years to bring a new mine online. 7 to 10 years. From discovery to production. And here's the problem. The major discoveries peaked in the 1990s. We're now mining deposits that were found 20, 30 years ago. And the new discoveries? They're smaller, lower grade, in more difficult locations. What that means is that even with gold at $2,700 an ounce, we're not seeing a surge in new supply. We're actually seeing production plateau or even decline at some of the major mining companies. Barrick Gold, the world's second largest producer, has been pretty open about this. Their production is expected to be flat or down over the next 5 years despite massive investment in exploration. Silver's even more interesting because it's primarily a byproduct of other mining. About 70% of silver comes from mines that are primarily producing copper, lead, or zinc. So silver supply is tied to the economics of those base metals, not to the silver price itself. And right now, we're seeing copper mines struggle with declining ore grades, labor issues, permitting delays. All of that impacts silver supply. But demand is exploding. Industrial demand for silver is at all-time highs. Solar panels alone are consuming over 100 million ounces per year now, and that number is projected to double by 2030. Electric vehicles use about twice as much silver as traditional cars. 5G infrastructure, medical devices, water purification. Every major technological trend of the next decade is silver-intensive. So, you've got supply that's constrained and demand that's accelerating, and on top of that, You've got investment demand that could surge if people start to realize what's happening. The silver market is tiny. Total annual supply is around 1 billion ounces. At current prices, that's about $25 billion. For context, that's less than the market cap of Chipotle. The amount of money that could flow into silver if even a small percentage of investors decided they wanted exposure is staggering relative to available supply. Now here's where your position as someone who already owns physical metal becomes incredibly valuable. You're not trying to get in. You're already in. You made your decision. You took delivery. You have possession. And that puts you in a completely different position than someone who's going to try to buy after the narrative shifts. Because here's what I think happens next. At some point, and I don't know if it's 6 months or 2 years, but at some point, the mainstream narrative is going to flip. They're going to suddenly discover all the things we're talking about right now. The supply constraints, the central bank buying, the geopolitical shifts, the industrial demand. And when that narrative flips, when CNBC starts running segments about the coming gold shortage, when Bloomberg starts talking about silver as the trade of the decade, what do you think happens to premiums on physical metal? We saw this in 2020. Silver eagles that normally sold for $3 over spot were suddenly selling for $10, $12, $15 over spot. And that was just from retail panic buying during COVID. Imagine what happens when institutional money tries to get physical exposure. Imagine what happens when pension funds decide they need 5% in physical precious metals. The premiums could go to levels that seem absurd right now. And here's the beautiful part. If you already own the metal, you benefit from both the price increase and the premium expansion. You're not paying the premium. You're collecting it. Your ounce of gold that you bought for $1,800 a few years ago isn't just worth $2,700 at spot. If premiums go to 10%, it's worth $2,970. If they go to 15%, it's worth $3,100. You're getting paid for having been early. But there's a decision point here, and this is why I'm calling this your moment. Because the opportunity isn't just to hold. The opportunity is to position yourself for what comes next. Let me tell you about something that happened in the 1970s that I think is incredibly relevant right now. In 1971, Nixon closed the gold window, ended the convertibility of dollars to gold. Gold was $35 an ounce. Over the next 9 years, it went to $850 an ounce. That's a 24x return. But here's what's interesting. It didn't go straight up. It went from 35 to 200 by 1974, then it crashed back to 100. A lot of people who bought at 190 sold at 110, convinced the bull market was over. Then it went from 100 to 850 over the next 6 years. The people who made generational wealth weren't the ones who timed it perfectly. They were the ones who understood the fundamental drivers and held through the volatility. They understood that when you're in a monetary regime change, when the rules of the game are being rewritten, hard assets are where you want to be. And they had the conviction to ignore the noise. We're in a similar moment right now. The monetary system that's been in place since 1971, the pure fiat dollar standard, it's showing cracks. Not because of some conspiracy, but because of math. You can't run trillion-dollar deficits forever. You can't have debt to GDP ratios above 100% without consequences. You can't print trillions of dollars and expect the currency to maintain its purchasing power indefinitely. And the people who are responsible for managing this system, the central bankers, the treasury officials, they know this. That's why they're buying gold. That's why the Bank for International Settlements, the central bank for central banks, has been quietly increasing the gold component of their reserves. They're preparing for a transition. They're just not advertising it because they don't want to trigger the transition before they're ready. But you don't have to wait for them to be ready. You can position yourself now. And if you already own physical metal, you're ahead of 99% of people. The question is what you do with that advantage. Some of you are sitting on metal that you bought years ago, maybe decades ago. You've watched it go up, go down, go sideways. You've wondered if you made the right decision. Let me tell you something. You did. But the real payoff is still ahead. Because we're moving from the accumulation phase to the recognition phase. From the phase where smart money quietly builds positions to the phase where everyone realizes what's happening and tries to get in at once. Your moment is the period right before that recognition phase fully kicks in. It's when you still have options. You can add to your position at reasonable premiums. You can diversify within precious metals, maybe add some silver if you're heavy on gold, or vice versa. You can think about how you want to eventually monetize this when the time comes, because there will come a time when you want to take some profits, and having a plan for that is important. But here's what you can't do. You can't ignore what's happening. You can't just sit on your metal and hope for the best without understanding the forces at play. Because this isn't just about price going up. It's about a fundamental repricing of monetary assets. It's about the market recognizing that physical precious metals are not just commodities. They're monetary assets in a world where trust in paper currencies is declining. Let me give you some specific things to watch for that will tell you we're moving into the next phase. First, watch the premiums on physical metal. If you start seeing sustained premiums above 5% on gold and above 15% on silver, that's a sign that physical demand is overwhelming available supply. That's when you know the paper market is losing its grip on price discovery. Second, watch the COMEX inventory levels. If you see a sustained decline in registered gold, that's gold that's available for delivery. That tells you people are taking delivery instead of rolling contracts. That's a sign of stress in the paper market. Third, watch what central banks are doing, not what they're saying. If you see accelerating purchases, especially from Western central banks that have been sellers or neutral for decades, that's a major signal. It means even the institutions that benefit most from the current system are hedging against its failure. Fourth, watch the gold to silver ratio. Right now, it's around 85 to 1. Historically, it's been closer to 60 to 1. If you see that ratio start to compress rapidly, it means silver is catching up to gold, which typically happens when industrial and investment demand both surge at the same time. And fifth, watch the narratives. When the mainstream media starts talking about gold and silver the way they talk about tech stocks, when you start seeing precious metals segments on the evening news, when your neighbors start asking you about buying gold, that's when you know we're in the late stages of the move. That's when you start thinking about taking some profits. But we're not there yet, not even close. Right now, most people still think precious metals are a fringe investment. Most financial advisors still recommend 0 to 2% allocation. Most pension funds have zero exposure to physical metals. We're still in the early stages. And that's why this is your moment. Because you have time to make decisions without pressure. You have time to educate yourself on the mechanics of this market. You have time to develop a strategy for how you want to play this over the next 5 to 10 years. And most importantly, you have the metal. You're not trying to chase a moving train. You're already on board. Now, I want to address something that I know some of you are thinking. You're thinking, I've heard this before. I've heard people say gold is going to the moon for years. Why is this time different? Fair question. And the answer is that the fundamentals have never been this aligned. In the past, you might have had one or two drivers. Maybe inflation was high, so gold went up. Or maybe there was a geopolitical crisis, so gold went up. But then the crisis would pass, or inflation would come down, and gold would give back the gains. What's different now is that we have multiple structural drivers all pointing in the same direction at the same time. We have monetary debasement. We have geopolitical realignment. We have supply constraints. We have industrial demand growth. We have central bank accumulation. We have declining trust in institutions. We have demographic shifts with younger generations more skeptical of traditional finance. All of these things are happening simultaneously. And they're not temporary. They're structural changes that are going to play out over years, not months. This isn't a trade. This is a position for a changing world. And if you're a retiree, if you're someone who's spent decades building wealth and now you're trying to preserve it, this is exactly the kind of position you want. Because the biggest risk you face isn't volatility. It's the slow erosion of purchasing power. It's waking up in 10 years and realizing that your savings buy half of what they used to. That's the risk that keeps people up at night. And physical precious metals are one of the few assets that have consistently protected against that risk over centuries. Let me tell you one more story, and then I'll wrap this up. I know a guy, I'll call him Robert, who's in his early 70s now. Back in 2008, during the financial crisis, Robert made a decision. He took about 20% of his retirement savings and bought physical gold. Gold was around $800 an ounce at the time. His friends thought he was crazy. His financial advisor told him he was making a mistake. His wife was skeptical but went along with it. For the next few years, nothing much happened. Gold went up a bit, went down a bit. Robert started to wonder if he'd made the right call. But he held on because he understood the fundamental reason he'd bought it. He didn't trust the financial system after watching it nearly collapse. He wanted something that couldn't be printed, couldn't be devalued by central bank policy, couldn't disappear in a bank failure. Then 2020 happened. Gold went from 1,400 to over 2,000. Robert's position more than doubled from his entry point. But here's the interesting part. He didn't sell. Because he realized that the reasons he bought gold in 2008 were even more true in 2020. The debt was higher. The money printing was more extreme. The system was more fragile. Now it's 2024. Gold's at 2,700, and Robert's position is up over 3 times from where he bought it. But more importantly, he's sleeping well at night. While his friends are worried about their stock portfolios, worried about their bond holdings getting crushed by inflation, worried about whether their pensions will be there, Robert knows that a significant chunk of his wealth is in an asset that's been money for 5,000 years. And that peace of mind, that's worth more than any return. That's what I want for you. Not just profits, though those are important, but the confidence that comes from understanding what you own and why you own it. The peace of mind that comes from knowing you're positioned for whatever comes next. So here's what I want you to do. First, if you haven't already, take inventory of exactly what you have. How much gold, how much silver, what forms, where it's stored. Know your position. Second, educate yourself on what's happening in these markets. Don't just take my word for it. Read, research, understand the mechanics. Third, make a plan. What are your goals? When would you consider taking profits? What would make you add to your position? Having a plan removes emotion from the equation. And fourth, recognize that you're in a privileged position. You saw something that most people missed. You took action when it wasn't popular. You have an asset that's about to become much more valuable, not just in price terms, but in terms of what it represents. A store of value in an increasingly uncertain world. They lied to you when they said gold was a barbarous relic. They lied when they said you should have everything in stocks and bonds. They lied when they said the dollar would maintain its purchasing power. But you didn't listen. You trusted your instincts. You bought the metal. And now, right now, this is your moment to capitalize on that decision. The next few years are going to be wild. We're going to see things in the precious metals markets that will surprise even people who've been following this for decades. We're going to see price moves that seem impossible. We're going to see premiums that seem absurd. We're going to see shortages that the mainstream said could never happen. And through all of it, you're going to be glad you positioned yourself when you did. This is not financial advice. I'm not telling you to buy or sell anything. I'm just sharing what I'm seeing, what I'm thinking, and why I believe we're at a critical juncture. You have to make your own decisions based on your own situation. But I will say this. If I were sitting on physical precious metals right now, I would not be selling. I would be thinking very carefully about my strategy for the next phase. And I would be grateful that I had the foresight to own real money in a world of paper promises. Your moment is now. Not because the price is at some magic number, but because we're at the inflection point where the narrative is about to change, where the mainstream is about to discover what you already knew. And when that happens, when everyone is trying to get in, you'll be glad you were already there. Stay strong, stay informed, and trust the process. The fundamentals have never been better.